Hey, Gemini, can you make a comparison back to back within Treasury bill ETF like TBLL and a junk bond ETF like JNK with dividend yields, expense ratio, tax advantages, price fluctuation, please?
Comparing a Treasury bill, T-bill, ETF, like TBIL, FDSUS, Large Cap Core ETF. Note, often confused with SGOV or CLIP for ultra-short T-bills, to a junk bond ETF, like JNK SPDR. Bloomberg High Yield Bond ETF highlights the classic trade-off between absolute safety and higher yield. While both pay monthly income, they occupy opposite ends of the risk spectrum. Side-by-side comparison feature TBIL, T-bill focused, JNK, high yield/junk, primary asset, 0 to 3 month U.S. Treasury bills, below investment grade, corporate bonds, dividend yield, approximately 3.55% to 5.3%. Highly variable with Fed rates, approximately 6.5% to 7.2%. Expense ratio, approximately 0.07% to 0.15%, 0.40%. Price volatility, minimal, moves in pennies, high principal stability, moderate to high, can drop significantly during recessions. Credit risk, virtually zero, backed by U.S. Gov. High risk of corporate defaults. Tax advantage, federal taxable/state and local exempt, fully taxable, federal and state. Deep dive into key factors. 1. Dividend yield and income stability, TBIL. The yield is tied directly to the federal funds rate. If the Fed cuts rates, your monthly income drops almost immediately. However, the payout is considered the risk-free rate. JNK offers a significantly higher yield to compensate you for the risk that these companies might not pay their debts. The income is steadier than the price, but in a severe economic downturn, some underlying bonds could default, affecting the payout. 2. Tax advantages, the state shield. This is a major differentiator if you live in a high-tax state, like California or New York. TBIL. Interest from U.S. Treasuries is exempt from state and local taxes. For many investors, this makes the effective yield higher than it looks on paper. JNK. Corporate bond interest is fully taxable at all levels. You keep less of the headline yield after Uncle Sam and your state take their cut. 3. Price fluctuation, volatility. TBIL. Because the bonds mature in weeks, not years, the share price stays extremely flat. It functions similarly to a high-yield savings account, but in ETF form. JNK. These bonds have longer maturities, usually 3 to 7 years, and are sensitive to the stock market. If investors get scared about the economy, JNK's price can tumble, even if interest rates don't change. It has a high correlation with the S&P 500. 4. Expense ratio, TBIL. Usually very cheap to run because buying T-bills is simple. You pay roughly $7 to $15 per year for every $10,000 invested. JNK. More expensive, $40 per year per $10,000. Because the fund managers have to actively research and trade hundreds of risky corporate bonds to avoid the ones most likely to go bankrupt. Summary verdict. Use TBIL if you are parking cash you might need soon, want to save on state taxes, or are worried about a market crash. Use JNK if you are seeking aggressive monthly income and can tolerate seeing your principal value drop 10% or more during risk-off market periods. Are you looking to use one of these as a temporary cash parking spot or as a permanent part of your monthly income strategy?
Well, it could be counterintuitive just by looking at the dividend yield, but if I had to pick between the two, I would pick treasury bills, ETFs. Also, there is BIL, which is the same thing. It is the short-term treasury bill ETF from TREASURY, and that charges you about 13 basis points on the expense ratio and pays you 3.96, I believe, dividend yield annualized. And TBLL, which is the same thing from Invesco, and it charges you actually only 8 basis points and it pays you 3.94, I believe, annualized dividend yield, which is great. I believe if you can then reinvest the dividends and increase your contributions to it, I would feel much more comfortable with treasury bills than junk bonds. Despite the dividend yield, the junk bonds pays you in between 6.5 and 7.2, because if anything was to happen, junk bonds are gonna fluctuate a lot, like it's already happened in 2022 with sticky inflation. Investors are gonna sell those junk bonds for the simple reason that if inflation is going up is 4, 5, 6%, you are making 5, 6% on the dividend yield. On top of that, you're gonna have to pay expense ratio, and you're gonna have to pay the capital gains on it, and at federal level and at the state level, where you realize that you're probably better off buying treasury bills, especially where the market is at now, which is closing up to the all-time highs. I really believe that if something was to happen, inflation was to go up, or anything, uh, oil price keeps going up, a lot of uncertainty with the Iran war, I would stick with treasury bill ETFs. In the case of a market correction or a stock market crash, well, in that case, I would look into junk bonds. But in 2022, actually, stocks and bonds came down a lot. In fact, if I was to look the the same ticker, which is JNK, but you can pull up all of those HYG, which is the same thing, but it's from BlackRock. Let me double check on here. JNK, and you go all the way back to 2022. Five years. That's exactly what happens. In 2022, it was trading at about 108, 109 bucks a share. And at the end of 2022, this thing was down to 90. So you went from 110 nearly to 90, which is a 20% drop. Now, in that case, really, it would have taken you a long time with a 6% yearly dividend to make up that loss. So I definitely think that you are possibly better off buying treasury bills. Now this is going back up, almost like it moves nearly like a stock, because the stock market is nearly at all-time highs. But if something was to happen and you have a scenario 2022 like, you probably are going to regret buying junk bonds. Let me ask Gemini, what happened in 2022 to cause the junk bond prices to drop nearly 20%? What was the reason for that?
In 2022, the junk bond market, including ETFs like JNK, faced a perfect storm that led to its worst performance since the 2008 financial crisis. While junk bonds usually drop because companies are going bankrupt, 2022 was unique because the crash was driven by macroeconomics rather than a massive wave of corporate defaults. Here are the three primary reasons for that approximately 20% decline. 1. The inflation shock and aggressive Fed hikes. Entering 2022, inflation in the U.S. hit a 40-year high, peaking at 9.1% in June. To fight this, the Federal Reserve launched one of the most aggressive interest rate hiking cycles in history, raising the benchmark rate from near zero to over 4% in a single year. The price/yield inverse. When new bonds are issued with 7% or 8% yields, the older junk bonds paying only 4% or 5% become much less attractive. The result: investors sold off their existing low-yield junk bonds, driving their prices down until their yields matched the new, higher market rates. 2. Duration risk, sensitivity to rates. While junk bonds are often thought of as shorter term than government bonds, they still carry duration risk. In 2022, even bonds with 5 years left until maturity were hit hard because the rate moves were so fast and so large. JNK and similar funds saw their principal value eroded simply because the math of rising interest rates forced the dollar value of every underlying bond to adjust downward. 3. Widening credit spreads, recession fear. A spread is the extra yield investors demand to hold a risky corporate bond instead of a safe government T-bill. Geopolitical turmoil. The invasion of Ukraine in early 2022 caused energy prices to spike and disrupted global supply chains. Recession fears. Investors began to fear that the Fed's aggressive hikes would cause a deep recession. When investors get scared, they demand a much higher risk premium to hold junk bonds. The math spreads widened significantly, from around plus 320 basis points to over plus 500 at one point. When spreads widen, bond prices fall, adding a second layer of losses on top of the losses caused by rising treasury rates. Summary of the 2022 double whammy. Factor: impact on junk bond prices. Rising interest rates. Negative. Older bonds became obsolete compared to new, higher-paying ones. Rising inflation. Negative. Eroded the real value of the fixed monthly coupon payments. Recession fear. Negative. Investors fled risky assets for safe assets. Flight to quality. In short, 2022 was a rare year where there was nowhere to hide. Both safe treasury bonds and risky junk bonds fell in tandem, though junk bonds fell further due to the added fear of corporate instability. Do you think we're seeing similar recession fear signals in the current market, or does the environment feel more stable to you now?
Well, it's for the very same reason. I believe we are in a perfect storm right now with the Iran war. We are in the same position, if not worse, of what we were in 2022, because the same thing is going to happen with the older bonds. They become obsolete compared to the new ones. And if that's the case, well, then people are going to sell their bonds, and they're going to have to sell it at a loss. And the inflation is going to go up. With the oil price, I believe about 90 bucks a barrel, or it was up all the way to 110, 120. Eventually, we're going to pay the consequences of rising oil prices and a lot of uncertainty of what's going on in Iran, and the recession too, because if inflation is gonna spike up, well, then we're gonna experience some consumer sentiment negativity. So I believe we are right there. This can be history that repeats itself. On top of that, I think that the Fed is going to have to raise rates because of inflation going up. I personally believe that there is a lot of dumb money in the market right now, and you'll see from people buying a whole bunch of small caps like Russell 2000, nearly all-time highs, and people are getting crazy buying AI stocks like Coherent, Momentum, and memory chips like Micron and SanDisk. It appears that investors don't even care about the price, and when that happens, eventually they're gonna drop hard. Those stock prices are gonna come down because sooner or later they're gonna face reality. And just like it happened with internet stocks, or it happened with the Nifty 50, you could have bought the Nifty 50 in the 70s, and those are the most indestructible companies at the time, and people didn't care about the price. People thought that there is no price too high for those companies, and sure enough, you would have bought the Nifty 50 in the 70s, and you would have lost 80-90% of your principal. So for all those reasons, but primarily because the Fed is going to have to raise rates. In that case, if you own treasury bills, you're gonna be better off. So in conclusion, I was undecided whether put my money into treasury bills or junk bonds, but I do believe that I'm gonna buy a whole bunch of treasury bills up until the situation is going to stabilize. And if the market was to come down, I'm gonna have the dry powder then to buy stocks or bonds, or I would have the options to do whatever I want with that cash. Also, if there was to be a stock market crash, usually people flock to the US dollar, and in that case, the value of my treasury bills are going to go up. So, for all of those reasons, I don't know about you guys, but I'm gonna stick with treasury bills.